You've been there. You spot a perfect breakout, the momentum looks unstoppable, and you hit buy. But the moment you do, the market reverses instantly, and your position is wiped out. Market makers engineered this move. Institutional players operate with hundreds of millions of dollars, and to fill an order of that scale, they require an immense volume of traders taking the opposite side. They trigger these false breakouts to pull retail participants directly into the line of fire. In smart money concepts, this exact scenario is called an inducement, or what you might simply know as a fake breakout. But you don't have to be their exit liquidity. By the end of this video, you'll have a definitive 3-step checklist to spot these traps before you risk a single dollar. To follow along, open your trading platform right now. Pull up your favorite chart and add 2 specific indicators, the stochastic oscillator and your standard volume bars. Once you see exactly how institutional liquidity flows, you stop being a predictable target and start watching the market like a professional. Step 1 begins with the price chart itself. We need to closely evaluate the exact behavior of the candlestick the moment it crosses a major support or resistance level. When you see a massive, fast-moving green candle breaking out, your brain screams at you to buy before you miss the run. Resist that urge. That unnaturally large candle is usually bait. Always wait to see if the price actually returns to retest that level. Look at this chart. When a breakout pushes through resistance, it looks like solid momentum. But watch what happens before it closes. The price rapidly shrinks back down, leaving a long upper wick. That wick is physical evidence of a trap, showing retail buying was completely absorbed by massive sell orders. This gives us our first concrete rule. If a breakout candle closes with a long upper wick, or a breakdown candle leaves a long lower wick, treat the move as an inducement. Stay out of the trade. Aggressive momentum often warns of an upcoming reversal. While amateurs rush in, professionals wait for this trap to resolve before moving. Now let's move to step 2. We are going to filter out those emotional, heat-of-the-moment signals by dropping our focus down to the stochastic indicator. This graph shows the stochastic indicator, operating between 2 boundaries. The top dashed line at the 80 level marks the overbought zone. The bottom dashed line at the 20 level marks the oversold zone. During a breakout above, we use a vertical line to cross-reference where the stochastic sits. Here is your rule for an upward breakout. If the price pushes past resistance, but the stochastic is already pinned above that 80, the exact same logic applies in reverse. If the price drops below support, but your stochastic is dragging below the 20 level, the asset is completely oversold. Do not sell into that breakdown. Relying on these specific mathematical thresholds cuts through the panic. It forces you to ignore the fear of missing out and stick to the data. That brings us to step 3, volume validation. If there is a universal lie detector in financial markets, it is trading volume. Market makers can easily manipulate the price on a chart to trigger a trap, but what they absolutely cannot do is hide the massive physical footprint of their institutional volume. Look at this setup. On top, a massive breakout candle. Follow the arrow down. The volume bars beneath it are completely flat. This tells you there is no real money here. It is a trap. Our final rule, a genuine breakout requires a massive volume spike. When volume surges, you have confirmation. Volume shows you the true participation of smart money. Without their literal financial weight pushing that candle, the breakout is just an illusion. Let's put this all together into a cohesive pre-trade checklist. Before you enter, check these 3 boxes. Are the candle wicks rejecting the move? Is the stochastic keeping you out of extreme zones? And finally, is the volume confirming the direction? Aligning these 3 distinct data points builds a reliable shield between your capital and a smart money inducement. Now put it to the test. Open your trading software right now, find the last breakout trade you lost money on, and run it through this exact checklist. You will likely see exactly where the trap was set. Mastering this framework means you no longer act as the market's exit liquidity. You start trading intelligently, right alongside the institutions. Drop a comment below and tell me what technical topic you want us to decode next, and I'll see you in the next video.